We will discuss the key findings and experiences from a report on private equity and agribusiness. This report is a result of a cooperation of 5 institutions, namely Credit Suisse, CDC, EMPEA, IFC, and WWF. Each of these institutions provided different angle in analyzing the role and key challenges for private equity funds in the agri-business space. The space that it's not easy to invest in, but so crucial for so many people and economies. We have 3 great speakers today. Mark Eckstein from CDC, Nadiya Satyamurthy from EMPEA, Josh Levin of WWF. My name is Piotr Mazurkiewicz and I am with IFC, and I will try to moderate our today's discussion. I hope everyone can hear me. So, first, a few administrative announcements. We have only 1 hour for all presentations and discussion. Please use a chat feature to submit your questions. We will focus only on questions related to this presentation. Most likely we will not be able to answer all questions. There are more than 150 of you today, but we'll do our best. This webinar is being recorded and will be available on IFC's website. And finally, all participants will receive evaluation form by email, and we count on your honest feedback. So now, agenda. We will have 3 segments and 3 Q&A sessions after each segment. The first one will be on framing the key issues, priority areas, and this one will be covered by Josh from WWF. Then Nadiya will talk about the state and trends of private equity in emerging markets, agribusiness. And finally, Mark Eckstein and myself will cover a roadmap for environmental and social risk management. So, Josh, the mic is yours.
Hello, everyone. My name is Joshua Levin, and I'm from the World Wildlife Fund. And you may be thinking, what is WWF doing on my webinar? I know we seem like the odd ones out in this collaboration. So let me just quickly give you a little background on why we got involved in the agriculture and finance space. It really started with WWF's global priority areas. These are key ecosystems around the world that we absolutely must protect. They're critical in terms of biodiversity, watersheds, carbon stocks, and other ecosystems. Pretty much across the board, agriculture was the biggest threat. And why is that? Well, just to quickly review, as you're probably aware, agriculture is responsible for about 85% of global deforestation. It uses more than twice as much water as all other sectors combined. It's the largest source of pollution, the largest user of chemicals. It creates nearly 1/3 of global greenhouse gas emissions. And already around the world, WWF is seeing conservation areas and protected areas being taken off the books. Now, this is the current situation, which is obviously unsustainable. But then let's review the outlook for the next 35 years. You probably know these things, but just a reminder that the population is going to increase by more than 3 billion. 70% of us will live in cities. That's as many as are alive today. Climate change is going to continue to shock supply chains, and income is going to increase by a factor of about 3, as will consumption. And in particular, consumption of vegetable oils and animal proteins, which have a multiplier effect on the underlying demand for grains. In short, we need to produce more food in the next 40 years than we have in the last 8,000 years combined. That's the entire history of agriculture. And with few additional resources remaining, we have no choice but to do so sustainably. That means we need more investment, not less, throughout the value chain, including inputs, production, processing, and trade. But it needs to be smart money that understands the risks and knows how to create sustained value by managing the natural capital, the ecosystem, and the surrounding stakeholders of an investment. Now, there are other forces at play as well. Within the industry value chains, in the recent years, there have been major commitments from some of the world's biggest buyers of agricultural commodities. And these are creating opportunities and pressures on potential investees. These are just a few examples on your screen. And increasingly, these industry players are starting to organize at the platform level with a pre-competitive agreements towards certification, deforestation, and other environmental issues, which are really creating a sea change in these markets. In an interesting parallel, in the banking sector, banks are starting to follow their clients and make similar commitments around certification, deforestation. Just these banks on your screen right now, in the past 18 months, all of them have made historic commitments in agricultural commodity sectors, placing big new requirements on their clients to access finance. And of course, institutional investors are organizing at the platform level around these issues and also individually placing mandates on their fund managers. And finally, there's the land grabbing issue, which investors face from the media and some of civil society. And this issue is not going to go away. Regardless of whether or not one is involved in any way in land grabbing or not, we are all going to be competing more and more for the same few remaining tracts of land that are viable for producing food for human consumption. Fortunately, there is a growing suite of excellent tools, most of them now web and cloud-based, which can assist in making smart investment decisions and informing those decisions. And finally, there's a growing field of credible certifications that can help you with verifying good practice and communicating that to buyers, LPs, and other stakeholders. So obviously, this is a complicated and dynamic space. It's a very important sector and very sensitive. And so the purpose of this report was to really bring together a diverse set of experts who could create a roadmap and clarify what's going on, what are the major trends, and what are the key steps that investors should take in order to manage these issues and opportunities. And to be honest, it comes out of real experience. Mark Eckstein, Andrew Alisi, and I, who are all presenting on this webinar, worked several years ago on a large private equity fund of funds focused on agriculture in Africa. And we faced a lot of these information challenges and found some solutions as well. And we decided we should be able to share our learnings. And that was really the initial catalyst for the further research that led to this report. So with that, I'm going to happily hand it off to my colleagues.
So, Josh, thank you very much for the presentation. We have 5 minutes for a Q&A session right now. And, we received a question up front regarding the role of certification. Mark and I will talk about this a bit later, but it would be great if you could, say a few words and your views on the role of certification in agribusiness investment space.
Absolutely. WWF has been involved in the creation and the advancement of a number of certifications in agri-commodities, not necessarily things like organic or fair trade. Many of them are more mainstream business-to-business certifications because we really believe that there's a lot of value that can be created there. For investors, I think the main benefits traditionally have been to verify good practice and to arguably reduce due diligence costs, because why should everyone send their own consultants or staff into the field when you could, in theory, be sharing the costs for a single set of experts who do that as their day job, and you would end up with a certification or verification scheme, which is what these are. And then you would want to communicate that you've done that credibly to other important stakeholders, and that's where it goes from a standard to a production standard to a certification. And increasingly, there's a third value as well. I think Mark's going to talk about it a bit, but there's a growing body of research around the impact on a company's bottom line from certification. And all the research I've seen indicates that not only does it reduce physical and reputational risks, but it can actually make companies more profitable by increasing documentation and verification within the company and operational efficiencies, as well as accessing premiums, managing labor issues, and other things. Again, I'll leave that to Mark, but this is not just window dressing. It's real value in terms of the functions of the investor and the functions of the business.
Very much, Josh. I think we can now move to Nadiya's presentation. Nadiya, the mic is yours.
Great. Thank you, Piotr, and my thanks to the entire IFC team for hosting this webcast. We at EMPEA were quite excited to be a part of this initiative, as we fundamentally believe that private equity can play an important role throughout the agribusiness value chain and really address a number of the challenges that Josh laid out in his slides. Private equity not only serves as an important source of financing to companies in this sector, we believe it's also very much about helping firms implement operational improvements that can maximize efficiencies, tackle environmental, social, and governance concerns, and then, of course, ultimately drive revenue growth. I'd like to briefly set the stage from a data perspective, and I know that data tends to be the least exciting part of any presentation, so please bear with us. But I'd like to walk through some of the trends that we are seeing regarding agribusiness private equity across the emerging markets. I will first provide a high-level data snapshot on the state of fundraising and investment for this sector, then look at how a few regions have approached the intersection of agribusiness and private equity in their own ways. And then finally, I'll touch upon the future outlook for agribusiness private equity in emerging markets based on the findings of our most recent annual Global Limited Partners Survey. So first, it's important to stress that agribusiness private equity remains very much a niche strategy across the emerging markets, representing only approximately 2% of total industry activity. There have been a few funds raised that are focused exclusively on this market segment. So for instance, between 2008 and 2014, 40 agribusiness dedicated private equity funds closed on nearly $6 billion in capital. However, much of the activity that has taken place in agribusiness to date has been driven by generalist funds that have selectively deployed capital into this sector. And really altogether, over about 150 private equity firms have invested in just under 300 known transactions across the emerging markets, again since 2008. Of note, last year we saw the highest annual amount of disclosed capital going into agribusiness, nearly $2.6 billion, and you can see that spike on the far right of the graph. Although I should caveat that this was primarily due to 3 large deals that took place in emerging Asia. Looking at fundraising from a geographical perspective, which is our next slide, you can see this shift in capital flowing into emerging Asia-focused funds, represented by the dark purple color, whereas historically Latin America in black had been home to the greatest percentage of agribusiness dedicated funds, having raised just under $2 billion since 2008. A lot of this capital, perhaps not surprisingly, has gone to the giant of the region, Brazil. While not highlighted on this chart, if we were to look at single country funds, Brazil-focused vehicles have attracted the largest amount of capital to date, having raised around 1.5 billion over this time period. Of interest, we've also seen a good deal of fundraising for sub-Saharan Africa over the last 5 years, which is depicted by the orange color. I think the key takeaway here is that despite the ebbs and flows, agribusiness investments are being targeted by private equity firms across nearly all emerging market regions, signifying a vast yet still largely untapped opportunity set. As I previously mentioned, a number of large deals in emerging Asia drove a surge in investment activity in 2014. And you can see that on this graph. And this is a trend that very well may continue into 2015, as the largest disclosed investment to date for this year took place in China. But prior to 2014, private equity firms had invested an average of approximately $1 billion on an annual basis, and did so through approximately 40 transactions per year. So again, I'd stress the total volume of disclosed activity remains relatively low in comparison to other sectors. However, these aggregate figures mask a great deal of diversity by market, size, and subsector. And we'll aim to take a closer look at each of these details in the slides that follow. So drilling down a little bit deeper, we've seen private equity activity taking place across the entire value chain that Josh laid out in his remarks, with many fund managers historically focusing their activity in agro-commodity processing. When viewed by subsector, the majority of deals have been in food producers, quote unquote, which means primarily processors, but also retailers. I should note that EMPEA has mapped all of our sector classifications to the FTSE industry classification benchmark so that we can better compare public and private data. And within FTSE's food producers category, 2 subcategories are included: food products and then farming, fishing, and plantations. And the latter is not necessarily limited to primary production. So this is really a broad category, but it is where we're seeing the bulk of transactions. So I'd like to switch directions a little bit and spend some time looking more closely at 3 emerging market regions that are leading agribusiness private equity activity, namely emerging Asia, Latin America, and sub-Saharan Africa. You may recall from the prior slide on the geographical dispersion, emerging Asia has really taken the lead in the last few years from a fundraising perspective. And a closer look at the region reveals that the majority of the investments that have taken place to date, probably not surprisingly, has been concentrated in just 2 countries, China and India, which together represent nearly 90% of total industry activity. But the truth is that this may be more so a function of the relatively advanced stage of development of the private equity industries within both markets, rather than a reflection on the state of agribusiness opportunities more broadly across the region. Despite this market concentration, we've seen a great deal of diversity in activity by subsector. In fact, with investments taking place in 16 subsectors between 2008 and 2014, emerging Asia represents the broadest array of agribusiness deals in any emerging market region. In particular, dairy operations have been a popular target for investment, as have protein producers and processors. In contrast, Latin America is a region that exhibits great diversity by market, but yet is concentrated by sector. Even though Brazil is home to the greatest number of transactions, activity is also taking place in several markets, including Argentina, Chile, Colombia, and Mexico, just to name a few. However, the majority of this activity has taken place in the farming, fishing, and plantation space. And also of note, I should say, forestry deals make up a greater percentage of transaction volume in Latin America than in any other emerging market region, at least to date. And perhaps this is due to the climatic and soil conditions in South America, but it is an interesting finding. And then finally, sub-Saharan Africa currently exhibits diversity both by country and by sector. Over 20 countries across the subcontinent have been home to investments in the agribusiness space, from the relatively mature market of South Africa to more frontier-oriented economies such as Burkina Faso or the Democratic Republic of the Congo. While primary production is a clear opportunity in the region, simply due to sub-Saharan Africa's abundance of land, A lot of activity is actually taking place in other segments of the value chain. In fact, one of our Africa-focused members working in this sector recently told us that compared to other emerging markets, greenfield agricultural investments in sub-Saharan Africa can be more challenging than some of these other segments due to the lack of infrastructure and weak logistics. So I think a number of these challenges highlight the need for emerging market agribusiness investors to integrate robust environment and social risk assessment and management practices into their investment strategies. And this is a topic that we'll cover in much greater detail later in the webinar. And then finally, to wrap up the data portion of this presentation, I wanted to touch briefly on the outlook for agribusiness private equity, which from our perspective is actually quite rosy. We asked nearly 150 institutional investors in our most recent annual Global Limited Partner Survey about their views on this sector. And by the way, anyone interested in a copy of this survey can download one from the EMPEA website. But in aggregate, 62% of LPs plan to increase their agribusiness commitments toward emerging markets as a whole, which interestingly actually exceeds their plans for clean tech, energy, and industrials, and is close to their appetite for exposure to financials. And then if you look at interest from a market-by-market perspective, as you can see on this graph, nearly half or more of the LP respondents are looking to build exposure to agribusiness in each emerging market region. So again, we believe this suggests that agribusiness private equity will be a sector to watch in the near future. And with that, I'll close my comments.
Agri-space. Hello? Can you hear me? Okay, let me repeat. It seems that my mic was muted. So Nadiya, there was a question from one of the participants related to how successful have funds been in attracting capital, and I believe that you addressed this in your presentation. But the second part of the question is about generating results. So how successful in general, from financial perspective, are funds that are primarily focused on agribusiness? So this is one question. And the second one, it's about the key impediments for investing in agri-space. You mentioned a few. If you could elaborate a bit more, it would be fantastic. Thank you.
Sure, thank you, Piotr. So to address your first question on performance, EMPEA does not track performance data, so unfortunately I can't provide any hard evidence on how agribusiness stacks up vis-a-vis other sectors. Anecdotally, I can say we've heard from both fund managers and LPs that agribusiness has generally held up quite well and in line with emerging markets private equity more broadly. But the reality is that the number of transactions in this space is still fairly small. And it's likely to follow the pattern we've seen with most sectors in this asset class, which is fairly wide dispersion. But again, unfortunately, I can't offer any hard metrics. To your question on impediments, I think a number of the key challenges that apply to funds targeting agribusiness investments in emerging markets are the same as those that apply to any emerging market private equity investment. Many emerging market companies continue to be plagued by a lack of things such as managerial talent, limited skills and training, corporate governance issues, difficulties in attaining all the necessary financial information, problems in securing bank financing to grow, etc. But of course, this is also where the opportunity comes into play because private equity investors are really well designed to tackle these issues. When you take a closer look at some of the key risks particular to the agribusiness space, there are quite a few. For instance, you have seasonal risks, unique environmental and social challenges, some of which Josh mentioned earlier in the webinar, potential issues over land rights, health and safety, human displacement, perhaps degradation of natural environments. And then, of course, each market's going to have its own unique challenges as well. Emerging markets are not all the same. So, for instance, crop production hasn't received much investment in China, perhaps due to evolving government restrictions on foreign investment in agribusiness firms. Or in India, the societal importance of smallholder farmers, may be a challenge for a private equity firm looking to achieve scale. So I'd say that the challenges or the impediments are many. But again, this is why private equity can make a lot of sense to an emerging market agribusiness firm looking to grow and best navigate these risks. PE investors offer patient long-term capital to firms in need, but more so than the capital, they offer expertise and networks so that companies can tackle inefficiencies, better attain scale, acquire new technologies and inputs, implement the right training and safety programs, etc. For a private equity firm, it's really about creating that value because this is how they themselves will be rewarded at the end of the day through an investment. And I'd say this is exactly why it's important for private equity investors to adopt sound policy and management practices, but I'll leave it to Mark to cover what that actually means in the next portion of the webinar.
Okay, thank you, Nadiya. Just one more question related to your outlook. Do you think that we can expect, in the nearest future, more sectoral funds, so funds primarily focused on investments in agribusiness, or we are rather talking about, generalist type of funds that would make a few more investments in the agri space?
Okay, sorry about that. I guess I must have lost you for a bit. But I was saying that across the board, we've seen an increase in sector-specific funds being raised. And so not only are we seeing growth in agribusiness dedicated funds, we're seeing the same with sectors such as education, healthcare, et cetera. So I do think we'll continue to see that trend continue. But that being said, the majority of the activity is taking place through generalist funds and probably will continue to do so for quite some time.
Okay, thank you very much, Nadiya. I think we can now move to Mark's presentation on environmental and social risks. Mark, it's your turn now.
Thanks, Piotr, and good afternoon, good evening, good morning, everybody on the line. So I'll bring the presentation to a close with a short review on environmental and social issues, and then we will ensure sufficient time for questions subsequently. So I think Josh set the scene nicely at the start of this webinar with a series of statements and images about why environmental and social issues are material to agribusiness investors. And they're represented on the left-hand side of this slide here. I would also very heavily emphasize that, at least as far as CDC is concerned, and I'm sure IFC and other responsible investors, the issues around labor practices are manifest in agribusiness, and they're probably the most significant issue as we look at agribusiness investments in our direct portfolio, but also through the lens of our funds. Every transaction we make or that we invest in employs people, and the terms and conditions of that employment are fundamental to responsible business practices. So I just wanted to make the point also that in addition to extremely important environmental issues, we also want to understand how these investments affect both labor practices and wider social and community needs. So then if you look at the right-hand side, which for the investors on the line will be where you might focus your interests, if you have all these environmental and social risks, what really are the impacts on the investee company's business prospects? Well, depending on the industry sector and the location and the commodity in question, it will increasingly affect access to international markets. It will affect access to capital raising, whether it's debt or equity. It affects the cost of production through poor use of inputs and poor practices around labor. And it affects product quality and volume, and also operational costs. And so there are significant E&S issues, and they are material to private equity funds, that is for sure. Just actually one point on land, a report that I came across over the last couple of weeks that I would heartily recommend to those of you who have interest in land and land rights and tenure, is a set of good practice materials produced by the Interlaken Group. It probably isn't available yet on the internet. They're just in the final process of refining and finalizing the PDF versions. But for those of you who are interested, it provides due diligence guidance for private sector investors who are looking to acquire or lease land in emerging markets. And it distills a lot of the wisdom of FAO and other broader public policy documents and turns it into very useful guidance for private sector investors. So for those of you who are interested, I can certainly provide you with that when it comes online, although the Interlaken Group will be opening up its website and putting that document on there for public access in the nearer term. So if we can agree that E&S issues are material, at the risk of sending a shudder of horror through all of you investors on the line, managing these aspects can be even harder. And I've just picked up 5 areas where I know CDC and I suspect Credit Suisse, IFC and other DFI and commercial investors have experienced particular challenges, and I'll highlight these briefly, and then I can answer more questions along with Piotr later on. The definition of boundaries are particularly complex in agribusiness because of the complex value chains and supply chains that support and enable primary production. Josh pictured this at the start of the presentation, but depending on where you are in that value chain, whether you're a primary producer relying on outgrowers or a large-scale producer with sort of industrial production, as is pictured on the right-hand image here, or somebody who is relying on that product flow, a trader, a food manufacturer, or a processor, there are boundaries that need to be managed, and the environmental and social risks that may be apparent in those value chains often, if we're being frank, are on the primary production side, need to be understood by investors wherever they are on that value chain, since increasingly they create reputational and other material risks. And obviously, the further away from primary production one goes as an investor, the more opaque is the understanding of those risks, and the less leverage and less influence you may have as an investor to manage those risks. But it's extremely important to understand where the risks are, just so that you're fully sighted on them. The next point relates to interaction of environmental and social and governance risks, and the one that's often cited, and I think is very, very important, is the interaction between a company's use of water and the reliance of that water supply by a broader community of people who may be living around a farm or a production asset. And there are a growing number of examples now of situations where social conflict has emerged around an agribusiness operation as a function of increased water use by that farm. And I think that is very important. And as we look at climate change and the impacts that will have both on the frequency and the reliability of water in many emerging markets and underpinning these production systems, I think it's extremely important that investors understand how the interplay of the water risks and the impacts on local communities can interact. Thirdly, brown and greenfield. Greenfield operations from scratch obviously incur more complexity, often acquiring land, which, as both Nadiya and Josh have alluded, can be very complicated in emerging markets. But just because you're investing in an operational brownfield plantation or agribusiness company doesn't mean that there aren't legacy issues around either water availability, land acquisition, or chemical use. So while greenfield is the more risky, I would suggest, brownfield isn't a complete plain vanilla investment. Cumulative and indirect effects relating to cumulative impact, cumulative demand on water, which I've alluded to previously, but also cumulative demand on labor in some markets is a problem. So you have, particularly around harvesting time, real challenges in gaining and securing adequate labor supply in a competitive market, which underpins the need to employ people fairly and treat them well, because our experience is that the companies that do that generally retain those workers and can derive a competitive advantage. And finally, evolution over time. Just because your environmental and social due diligence has shown that you've got a relatively simple transaction with low environmental and social risks doesn't mean that that's going to be the case throughout the period of your holding. Many PE funds are looking at 5-10 years of holding, and the conditions around local communities, around water supply, around climate, around soil quality, all can change quite dramatically over a 5 or a 10-year period. And so really the hard work begins when the deal is closed and the company has to begin to deliver on some of the environmental and social requirements that an investor may have placed on the company. So findings and delivering value add, and I'm going to talk to this and then let Piotr come in at the end to add some observations and experiences from the IFC side. Very importantly, and these are just sort of points that struck me when I was thinking about what messages would I want to relay to an audience of private equity investors on this webinar. Align expectations and interests from the start with investee companies. So begin the conversations around environmental and social expectations at the get-go, and make sure there is an understanding of what that means for the investee company. And often that may be a learning journey for the investee company, but it's very important that that conversation takes place as early on in the process as possible. But also recognize, and this plays to a point that Nadiya mentioned earlier, that capacity constraints in companies are often very significant, whether it be in management or in the environmental and social capacity within the company. So accept that these things are going to take time to resolve, figure out what the priorities are in resolving them, agree those priorities with investee companies, and work at it over time. And certainly CDC, and I know IFC as well, develop environmental and social action plans that we build into our investment agreements for our direct investments. And we look at how we're going to improve performance over time. And as long-term investors, that's part of the value add we believe we bring to our investments. Importantly in that process, understand the risks and try and manage those first and foremost, but do have an eye on where the opportunities lie. And I haven't talked much about the opportunities, but the corollary, if you like, of all of the risks that I've been talking about are opportunities. And the report we've launched includes a table which maps out where opportunities and risks can be sort of matched against each other. But treating labor fairly, giving employees a living wage, managing their health and safety risks is a really important and fundamental business benefit and value driver across the agribusiness and value chain sector. Build the capacity and management systems within investee companies over time, and as I've said, this does take time, and accept that it is going to be an opportunity cost of fund management and staff, but recognize that and accommodate it in your assumptions about the management of investee companies. Leverage knowledge. Now this is, of course, we produce this report, which we think is the best thing since sliced bread, and will answer many of your questions, but it won't answer all of them, if I'm being honest. And there are lots of other good documents out there in the market, and I would just point you, for those of you who don't use this resource, but the IFC discloses a lot of extraordinarily good information on its project database. And you can interrogate that by industry sector and location, and it is an extraordinarily helpful way. This is their environmental and social review summaries. This is an extraordinarily useful tool in understanding the general environmental and social risks and opportunities you might find. So that's a good source of information, and I would be remiss if I didn't also flag that CDC has just launched its online ESG toolkit for private equity fund managers, which is available on our website as well. And finally, measure and report on performance. And as an LP for many of our funds, I do so enjoy reading your reports, ladies and gentlemen. But the reality is these reports are actually better focused and more valuable to the fund than perhaps the LP. And I would urge that the reports that you receive from investee companies are an extremely valuable insight into management and the way that companies are addressing your environmental and social expectations, and they should really inform the way that company is working. So while it's nice to receive them as an LP, as a GP, use them to inform your understanding of a company and investee company behavior and shape their performance. Piotr, I don't know whether you have any additional thoughts or comments before I move to the next slide.
Mark, just a few, in fact, two additional comments from my perspective. The first one is related to capacity. What we observed in the past is that those sectoral funds, they have sectoral knowledge, they have sectoral expertise, and usually they are quite aware about key environmental and social risks in this sector. While this is not necessarily the case in case of generalist type of private equity funds, which invest in different type of companies, and from time to time they also decide on investing in agribusiness. The sector is very specific, and the risks related to the sector are very specific. Whenever the fund manager decides on investing in agri-space, I would really recommend to spend some time on better understanding the key risks related to particular subsector or the sector in general. So this is one comment. Another comment is about the leverage in general. The leverage of the fund manager to manage environmental and social risks. This is, one of the, I would say one of the key challenges, because on one hand, we believe that the fund managers they should properly take care of environmental and social risks in their investments, and then they should require or work with investee companies on managing those risks. The reality is that very often fund managers, they take relatively small stake in the companies. Yes. Reality is that sometimes fund managers acquire stakes through secondary market where their leverage is limited. So this is, the whole space of additional impediments or additional challenges for the fund managers related to environmental and social risk management. So I'm just flagging this now. Maybe we could discuss this more during the Q&A session, but now go ahead with the rest of your presentation.
Thanks, Piotr. And I think that is a very important point, the influence that fund managers have over or within individual investee companies. Very variable and an important point for us to reflect on. So moving on to the penultimate slide, and I'm conscious time is ticking on, so I'll cut through these two reasonably quickly so that we have time for questions. This slide relates to the environmental social management system structure that we want to see in both investee companies and the funds we invest in. But I'll focus my comments on what we would hope to see in the environmental and social management system of the agribusiness company that is the investee target of the fund in this instance. And there is a great deal more information and guidance around what is needed in the report that we're launching. I think the building blocks of a good environmental and social management system on the right-hand side of this slide. Many of you, I imagine, are very familiar with this structure. I would say a few key points. Integrate environmental and social management systems within the farm management system or the management system of the investee company, rather than necessarily creating a standalone and parallel shiny new environmental and social management system. Don't burden investee companies with additional management systems if there is sense and value in integrating into pre-existing. Only make these environmental and management systems as large and complicated as they need to be. There's no need to create a massively complicated multi-volume document unless you are dealing with a massively complicated multi-sited asset. So, you know, these environmental and social management systems should be fit for purpose, since ultimately they need to guide and inform the way the investee company manages environmental and social risks. In the environmental and social management system, they tend to be risk focused, if I'm honest, but bear in mind that a lot of the value drivers that we've been talking about can really be understood most clearly through the lens of these management systems and monitored and reported against additionally. There is often a need to, as Nadiya said and I mentioned also, there is often a need to build capacity within investee companies so that these management systems can be fully and effectively rolled out. And very importantly, the bottom stakeholder engagement piece in this graphic on the left-hand side, for those investee companies involved in primary production, having an effective stakeholder engagement and community grievance mechanism is extremely important. It's the window into your social license to operate. And I've seen many companies who don't do this, and many of them live to rue the absence of those stakeholder engagement mechanisms. So just moving then on to the last slide, which is one I'm going to return to this question of certification that Josh mentioned. Increasingly, as he suggested, this is a proxy for good environmental and social performance that can be reflected up and down value chains, but also to investors. I've mapped out that there are costs attached to certification. Maybe on the left-hand side here, reduced production area through the removal of some of the farm asset because it is high conservation value land, HCV being a sort of a biodiversity designation. There are costs involved in the segregation of certified and non-certified product, and there are certification costs as well associated with having an auditor visit your site and determine the quality of environmental and social performance. And I would make the point also that, and Josh alluded to this, that price premiums are lovely to get, but shouldn't be assumed. If you get it, it's like the icing on the cake, but I don't think you should base your financial projections on a price premium. But having said that, and painted a rather downside picture of certification, our experience is that the benefits always outweigh the costs. Increased access to capital and international markets being a big benefit, and I think will grow. Better management of input and labor costs, and the report on the right-hand side, which was commissioned by FMO, CDC, and undertaken by WWF a couple of years ago looking at palm oil, is a very interesting analysis of where the cost benefits lie, and this can be downloaded from any of our websites, and I think is worth looking at in terms of where the real value drivers are around input and labor costs. Staff motivation is clearly important in some sectors, and it is clear that the values of good labour practices and good environmental and social performance are aligned with many employees and can be a staff motivator. Community relations are extremely important in some industry sectors, particularly palm oil, sugar, soy and beef in some markets. And the benefits of supply chain traceability are also manifest. So I will call it a day there, Piotr, and leave whatever time is left.
Thanks, Mark. In fact, we can maybe start with a question related to the last slide on certification. There is a question from one of the fund managers operating in Africa, and the question is related to the key issues, risks in agribusiness, and primarily from the point of view of small and medium enterprises. Very often, you referred in your presentation that there is a significant cost related to obtaining certification, and in many markets it's practically available only for large scale farms or plantations. Could you just share with the participants your views, what could be done in case of small and medium enterprises, and whether a certification is also a good way for them to go forward?
Well, that's a large question. I'll try and answer it as succinctly as I can. I would say that although I think certification is important for many, it isn't a universal panacea, and it may be, depending on the crop or the production system.
Hello, Mark. Can you hear me?
Yes. Can you hear me? Piotr, can you hear me now?
Okay, I think we lost Mark. I hope he will rejoin in a couple of seconds. So there is another question related to commodity. Oh, Mark, are you back?
I thought I was back previously, Piotr, but you couldn't hear me. Can you hear me now?
Yes, I can hear you now. So have you started answering the question?
Yeah, let me answer it succinctly. I think it depends a little bit on the commodity and the volumes of production, but there are group certification systems for some commodities now. But certification for small-scale production that doesn't have access to international markets may not be cost-effective. So you shouldn't presume that certification is the.
Yeah, I think this is Josh Levin here. I think Mark's fading out a bit, unfortunately, but he was obviously, I think we all heard that he was sharing that it's not necessarily a solution for everyone, and the cost can be prohibitive, especially for small-sized producers. And I wanted to add a quick counterpoint because I've been involved in a piece of research on the FSC certification in forestry. Over the past year and a half, we've been doing primary research around the world, including in Africa. And the irony is for small and medium producers, especially in the tropics, they actually had the biggest financial gains from the certification. But of course, they're the most cash sensitive, and they actually had the longest ramp up time to achieve that certification. So I think could potentially point to the important role of finance to help them get over that hurdle, but ultimately realize the benefits that we've been seeing in that resulting from the certification.
Okay, thank you, Josh. We have another question, and in fact, it's great that you are on the line as well, because it's related to commodity risk analysis. And maybe I will start answering this question from IFC's perspective, but I know that WWF has a lot of experience as well, and in fact, we have joint experience with the global map of ENS risk in agro-commodities production. This is something that originally was designed for IFC's real investment clients. Then we also started using this in case of trade finance and agro or financing soft commodities. Primarily there is a matrix of about 100 different commodities in different countries, specifying risks related to labor, child labor, forced labor, occupational health and safety, and risks related to impacts on biodiversity. The map, as I mentioned, it includes about 400 different combinations, and it's going to be improved over time. And I think, Josh, if you could say a few words about WWF's experience on this, it would be great.
Sure. I caught your answer, but not so much about the initial question. But Piotr was reviewing this GMAP tool, which comes from demand in the financial sector and also in industry, to actually identify what are the risk levels on a sector and geography basis. So GMAP is a tool that it's been piloted by a number of institutions over the past 18 months, 2 years, and will be available publicly in some form by the end of the year. And I should mention that FSC report that on the costs and the benefits from that certification, that's coming out August 5th. So I don't know if I'm fully answering the initial question, Piotr, but yeah, maybe we should give some of the other questioners a chance.
Okay, so we have a question, and I think it should be directed to Nadiya. It's about whether are funds lending directly to producers irrespective of size, or are they using implementing partners?
Sure. So we are seeing funds lend directly to producers, but I would say that's really representative of a small portion of overall activity. In particular, we haven't seen a lot of capital going into primary production. There are a number of reasons for that. Two of the main ones being issues over land ownership, and then an incompatibility between the economics of production and then the return expectations of investors. It's just a much less predictable investment stream. And so we're seeing the bulk of investments going to other parts of the value chain, further up the value chain, I would say. And certainly scale is important to many private equity investors. So I would say it is happening, but not to a great extent.
Okay, thank you very much, Nadiya. I think we used our 1 hour. It's already 11:04 in Beijing. It's p.m. It's 11:04 a.m. in Washington D.C. So I just wanted to thank you very much for participating. Thank you to CDC. Thank you for EMPEA. Thank you to WWF, and of course, a big thank you to Credit Suisse. As I mentioned at the beginning, the record of this seminar will be available on IFC's website, and we will send evaluation forms to the participants of the seminar. So please send us your feedback. We would greatly appreciate it. So thank you very much, and hopefully we will have another similar webinar in the nearest future. Bye-bye.